30th of November, where every Monday at midday, a panel of industry thought leaders from business advisory and tax, risk management, property, superannuation and investments, employment and HR give their insights into the current economic and financial landscape that impacts small to medium businesses in Australia during this pandemic and beyond. My name is Lisa Garrido. I will be your host this morning, introducing the panel of small business leaders in their area of expertise. I should also provide the following general warning that the views and opinions shared in this webinar are designed to be general information only and are not designed to be taken as specific advice for your personal and specific circumstances. Please feel free to reach out to any of the panel members at the end of the webinar through Facebook or LinkedIn or YouTube for specific advice to meet your requirements. So I'm going to start this morning. I'd like to introduce Adam Lyle from BizDoctor.
Hi, Lisa. Thanks for having me.
Thanks, Adam. Ian McLaughlin from Imperium Accounting and Tax.
Hi, Lisa. Thanks for having me. Welcome, viewers.
Good day, good day. And Sam Garashi from MoneyClip Group.
Welcome, everybody. Thank you for having me on board.
Today, we are missing Bernard Tuimau, who is from MGA Insurance. He's just on a very privileged trip with a client today. We miss you, Bernard, and hopefully you'll join us next week. So today, I'd actually like to start with you, Ian, in terms of any updates from you, as you did last week.
Thanks very much, Lisa. So I'm going to touch on three things today. The first one, as we touched on last week, is today is the last day of November, 30th of November, which basically means today is the last day that you can submit the October job declarations with the ATO, JobKeeper that is. And remember that the ATO extended those from the 14th of November to the end of the month because of the IT issues that they were having earlier on. So next up, I just wanted to touch on something that's happened in Victoria for our Victorian viewers. So there's been a measure that the government's announced down there, which they're dubbing the new jobs tax credit. And it's going to see eligible businesses receive a credit of 10 cents for every dollar of Victorian taxable wages that is above those wages paid for the previous financial year. So it's available to businesses with a payroll of less than 10 million a year, and it's going to run for 2 years. So let's look at an example of how this is going to work. Let's say that a business increases its taxable wages by $100,000 in the 2021 financial year compared to the 2020 financial year. They would receive a credit of $10,000 to offset against its 2022 Victorian payroll tax liability. So the credit is going to be received automatically through their payroll tax obligations, and it's going to be non-refundable, which basically means it's going to reduce the payroll tax liability and it can't be reduced to zero. So I think that's a really interesting initiative for our Victorian viewers. Another interesting thing announced is that the government has said that they're going to introduce new legislation to expand access to the full expensing measure of depreciable items. So remember, this was a federal budget measure that became law on the 14th of October. And the current measure allows businesses with an aggregated turnover of less than 5 billion to deduct the full cost of eligible depreciating assets of any value in the first year that they use or installed. The changes announced, they're going to include businesses that have an aggregated turnover of more than 5 billion due to income from an overseas parent or associate. So they're now going to be able to qualify for that measure. And another interesting thing on this, this instant asset write-off is that the government is also going to introduce legislation that businesses are going to be able to choose whether or not they actually use this. And it might sound ludicrous, but yeah, it might be more beneficial for some businesses not to expense or depreciate these items 100% in the first year and to depreciate them as per normal and hold them on their balance sheet. So it's going to provide businesses with more flexibility in respect to these measures. And it's also going to help businesses that maybe run under a trust structure, because having to fully expense an asset could push the trust into losses and therefore leave them with no income to distribute. And that could mean that the individuals who rely on distributions through the trust as income could miss out on income and accessing the tax-free threshold. So that's it for me today, Lisa, but I think some pretty interesting developments there.
Definitely, my gosh, all governments, all levels are doing whatever they can to try and keep us all afloat, isn't it? Adam, now that then leads on to you. Any updates from your end on investments?
Is that me? Sorry, I thought you said Sam. My apologies if I've
No,
missed
no,
it.
no. You, Adam.
There
That's
you
you.
go. I'm not as good looking, obviously, so that means I'm going next. The situation from me is that the legislation in relation to the amendments to the Corporations Act are still proceeding through the Parliament. It doesn't seem to be proceeding as quickly as we thought. We think that industry bodies are now actually having a bit of a weigh in because they didn't get too much of a chance to do that prior to the legislation being put forward. So we'll watch this space. We'll see how that goes about. The interesting perspective with that, of course, is that there is definitely no change to the view that the moratorium will finish on New Year's Eve. So we expect that there will be a plethora of people under pressure post 1 January. Happy 2021. Today, I wanted to catch up with a question that came up last week is, because the last few weeks I've been talking about insolvent trading and the risks associated with that. And most of us in business are either the director or the shareholder or both of the businesses that we're operating. And a lot of us are there also on title, either as direct owner of a property or as the trustee of a trust in some way, shape or form of the property that you're owning. If you are the director of an entity that for some unknown reason, way beyond your control, is under attack, then you could be exposed insofar as that if a liquidator is appointed to ABC Proprietary Limited and commences an action against you as a director, either for breaches of the Corporations Act sections 180 to 184, which would talk about the director's duties, or insolvent trading, or some other type of transaction that was entered into in the years prior to that liquidation, and in some circumstances those transactions could go back 10 years, then the very home that you're on title for could be exposed. Now, that's the first thing. The second thing is, let's assume that everything's hunky-dory and you haven't done anything wrong, and you've, over the years, have put money into your business. You've drawn down on the home loan last year and you wanted to get a new pool and you thought, oh, look, I've got enough equity there. I'll draw out another 50,000. I'll put it into the business. It could have been 100 grand, whatever the situation is. Many, many people do not properly document the loans that they give to the companies that they are the owners of. It's very blurry, those lines. They don't absolutely delineate the difference. And they certainly don't document the first advance. And I would imagine, particularly during the COVID crisis, where they've probably drawn down on their home loans to supplement the cash flow for the business, they haven't documented any of that either. Now is the time to act. How do we act? First of all, talk to your accountant. He'll bleat out things like Division 7A loans and all this sort of stuff. That's all great. But make sure that there's a proper opening balance and there's a proper closing balance, and that all of the transactions that are entered into both ways, so wages, repayment of loans, expenses, non-direct expenses, all of those things need to be documented and put into place. Then whatever the opening balance was, let's assume that there was a transaction that was entered into 2 years ago. A proper loan account needs to be established with proper terms, just like you'd get from a bank. And you need to properly have this on record and recorded both from a taxation perspective, and I'm certainly no guru on tax, that's why we've got Ian here, but certainly from a legal perspective. And I'll tell you why. Let's assume the worst happens and your company doesn't survive or is under pressure. then any transactions that you're entering into between you and the company can first of all be attacked. Second thing is, why, if you've put, call it $250,000 into your company, why should you stand in line with all the unsecured creditors? Why? That's your blood, sweat and tears. It's your bricks and mortar you put on the line. It's your family's home that you've put on the line for the business. Why shouldn't you protect it to make sure that you get your 250 grand back? Because I can tell you now, if you go to any bank and ask for 250 grand, they're going to want your bricks and mortar. They're going to want security. So why should you be any different? And a lot of people have been using the advantage of getting really good home loan rates and using the lower interest rates on their home loans to inject that capital into their business. How do we fix it? A, talk to your accountant. B, get a business health check. Make sure you know exactly where it's all at. And please protect your investment in your business. Think of it like as if you're the lender. And you would want to make sure that your investment and your lend and the money that you've lent out is actually protected. That's it from me today. I hope that's been helpful. And I'm sure that's going to raise some questions.
Certainly does. I have a question, but we'll put it off for later. Sam, over to you. Any updates from you?
Yes, thank you. So a couple of things to cover off for you guys this week. One is around interest rates and the other around the markets. Firstly, not a lot of changes from a bank's interest rate perspective. However, the bank's assessment rates, I've spoken about this before, they are falling and more banks are following that through. And that's really good news. In tough times, going back a few years back, bank loans were a big issue because the banks used to use a benchmark of 7.25% to 7.5% as a way for them to calculate if you can make repayments. And hence that would actually impact on your borrowing power, essentially. Through the changes in the rates of recent years, and this has been reduced now to mid-5s for some banks, even sitting at 5 for some, and in fact at 4.95% for one of the major lenders. And this has the impact of essentially improving your borrowing capacity. And of course, that allows you to get into the market, which is probably one of the reasons why we've been hearing of recent times that the auction rates have been holding up quite well and properties are actually selling quite quickly. And certainly in the area that I live, I've seen that the time on the market for many properties that you would have thought that wouldn't be the case, it's really come down. So for the first time in a while, we're going to see some strength going into December, which is what wasn't expected at this particular time, given everything that has happened today. What I did want to touch base on is firstly the home builder subsidy that the government provides, and that's been extended to the 31st of March. So we still have more time to go. And that means that you've got to the 31st of March for you to sign your contract and to enter into those, the contract in order to be able to get the home builder. But what you need to be mindful of is the building construction couldn't have started before 4th of June 2020, because that's when the government announced it. So if you buy into a property where the construction started before that, you need to check back with your conveyancer or your lawyer and just to make sure that that actually fits in. One warning that I want to give is, and this is from some of the questions that I've had from our clients in particular, you know, what if I use my home to buy a car with, home loan to buy a car with, and then just pay it off over time? So thinking about a car that's essentially a depreciating asset, goes down in value quickly. You know, if you've got that loan for that car for many years, you're going to pay many times over of that value of the car just in interest. So I would warn you that if you are looking to do a car loan off your home, almost treat it the same as if you had a car lease. So, you know, have the intention to basically pay it off within 3, 4, or 5 years. And that's going to ensure that you're not going to pay too much interest on that particular car. And sometimes, you know, I hear of clients where they have a loan on the car that they don't have anymore, right? So obviously that's not a great idea. Just like what would happen, say, with a credit card expenditure when you spend too much money on that. And, you know, you can't account for any other stuff that you spend money on. Now onto the market. So markets had yet another solid week, rising by about 0.9%, and to give us the best month so far over the last 30 years. Yes, over the last 30 years, it's been unbelievable what's actually occurred in November. So far, we're up 11% in November alone, and that's been led by the banks and the miners in particular. Now, again, the market is ignoring the short-term pain of COVID running rampant in the US and Europe, although the numbers in Europe have started to come down a little bit, which is obviously hopeful in some shape or form. And a question that I have been asked is, should I be investing right now? Well, it's a complicated question to answer. I would say, given the large market rally that we've had, we just need to be still cautious. You can only ever tell whether it was a good time to invest or not after the actual period of time has actually passed. So then when you look back, you say, yes, that was a good time, or that wasn't a good time. So I want to touch base on a topic that would go hand in hand with that, and that is called time in the market rather than the timing of the market. What that means is that the time in the market is about investing over a long period of time and having that long-term view, rather than selling, buying, or selling and waiting to purchase at a point in the future. We all have some type of biases towards the way that we invest. And so often when you're trying to time the market, you could easily miss the better days to get back into the market, or things can actually occur where you essentially miss out for a period of time before you go in. And that could be the difference between many amounts of percentages of return that you could get. So my recommendation to you is to obviously ensure that you have a time in the market mentality, more so than timing the market. Now, in terms of how that actually all works out, well, you've got a process where you call drip feeding or dollar cost averaging. And I'll give you some examples of that for you next week. So then hopefully that'll solidify the conversation. And that's my update for today.
Oh, Sam, thank you so much, as always, for all the tips and advice, if you like, across such a broad spectrum. Again, viewers, if you have any more questions on the areas that Sam covered, please reach out to him on LinkedIn at MoneyClip. Now, for my update this week, I guess I just wanted to cover a couple of things, and it's really looking at strategies now that anyone in HR, anyone in business that also looks after the HR requirements of the business need to consider. So as everybody's aware, a raft of COVID-19 public health measures are set to be repealed, particularly in New South Wales, as Gladys Berejiklian is urging businesses to bring back employees to the workplace. As we know, from tomorrow, the 1st of December, New South Wales will see groups of up to 50 people allowed to gather in a public space. So this public health order that required employers to allow employees to work from home, this is during the pandemic or during the start of the COVID, will also be removed from the 14th of December. So essentially, all employers have 2 weeks from tomorrow to really look at hunkering down and planning the return to work strategy if they are looking to encourage the employees to return back to the workplace. So the changes really is designed to encourage businesses and organizations to consider having more people back in the workplace in a COVID safe way. So again, up to 50 people will be allowed to gather in public spaces and in private residences, as long as they are outdoors. And for indoor gatherings, the number remains to 30. So the relaxation of the rules comes after 18 days without any locally acquired infections in New South Wales. So it's hoped that employers will feel increased confidence in bringing their staff back into the workplace. Now, obviously, the Health Minister, Brad Hazzard, also has warned people to remain vigilant, warned businesses to remain vigilant, particularly in cases of safe public transport. So repealing the work from home order would see an increase in the number of people using public transport. during peak times and urged commuters to wear their masks or face coverings. So what that does obviously is brings up an opportunity for recruitment as talent pools begin to open up again. So the reopening of Australia's most critical border, that's between Victoria and New South Wales, will see a significant shift in recruitment in businesses who are now looking to secure new talent. This is because more people are feeling more safe to start to travel again and consider relocating and looking at areas where there is more buoyant opportunities for them to be employed, particularly during this pandemic. So most HR leaders really would look at this as developing a competitive advantage or competitive package for all employers, both in terms of salaries and also their internal recruitment processes and obviously their internal onboarding processes. So you would really need to address remote onboarding strategies at the very least to review your onboarding issues and definitely looking at reviewing your packages and benefits. One of the biggest shifts from pre-pandemic times has been how job applicants are now prioritizing their prospective employers based on their health and well-being programs. Very interesting, isn't it? Something that was always considered an afterthought pre-pandemic. So the increasing priority of employee well-being has risen during the pandemic. So you really need to consider if you are in a recruitment campaign on what you would say to the candidate when asked that question. Also, there has been a noted shift in the market for applicants focusing on where they want to work rather than a specific role. By removing a location in certain job postings, a company called Findex that's got 110 locations across Australia and New Zealand has been able to open remote roles up to new talent who otherwise may have been restricted by geography. So it's a really good strategy for an organization that has a lot of locations to try and not post the location of the role so that it attracts new talent and good talent at that. So it will then allow employees to have the best of both worlds, the role they're after and the flexibility they are seeking. As I've been mentioning in the last few weeks, employers have to consider more flexible arrangements around this area. So just definitely as a tip, make sure that you have a flexible approach to recruitment, particularly for those in Victoria when job applicants are now applying. Be very conscious of how you are rejecting an application and be very sensitive with language that you use when you are actually closing an application off. So again, the tips, just to recap, with the border reopening, it's a key time for recruiters and employees who have been nervous about moving and recruiting because talent is now going to be opened to a wider pool. Look at reviewing your salary packaging to look at employee health and well-being benefits. Look at your onboarding process. Is that up to scratch? And be mindful of applicants in Victoria who have experienced the toughest lockdowns globally. And this should play a really good part in your rejection process. So that's really it from me after all the announcements last week. Now back to the panel. Do we have any questions? Do we have any questions from viewers at this stage? So Adam, and Ian, probably for you, earlier when you indicated that for owners or directors of companies who have intercompany loans or personal loans that they've loaned to the organization and their business, and you said that we need to make sure that we put this down in very strict terms as if you were borrowing from the bank. Can one of you shed light on what these terms should look like? And should this be in writing? And if so, who should put this in writing?
Absolutely. I was just going to suggest, Adam, because I think it's a really good point that you touched on, and it's probably going to be a longer than a 1 minute answer to that. So why don't Adam and I, Lisa, pick up on this next week?
Perfect.
And give it a good 5 minutes, because it is a really important piece. So we'll do that next week.
Yeah, that's valid. That's great. Do we have any other comments or feedback from each other before we wrap up? All good. Thumbs up. All right. So viewers, hope you enjoyed the webinar this morning. Hang tight for next week for more updates, and hopefully with Bernard Tuimau back on board. Have a good week, everybody. Have a good day, and see you next week.
Thank you, everybody.